Fabio, so good to speak with you.
See you.
So that this headline when it comes to Blackstone seems really concerning because it's kind of another negative headline when it comes to real estate, commercial real estate in particular. How do you read the headline?
Well, really now we can just summarize it in one word. Woomph, I think was the term, right? Is that the international term for a lot of money going away?
Can we banner that, please?
Woomph. I think Blackstone finds itself in a tough spot because they were the poster child for sort of bringing institutional investments. It's not a REIT. It's structured differently. And I think that what do retail investors have? You're targeting retail investors, and what do they have as their fears? One is their fear of COVID. Mm-hmm. Two is their fear of work from home occurring forever. Yeah. So buildings will be empty. Three is they walk down any street and you want to name in America and you see 5 empty stores for every 3 that are full, right? They're worried. Why? And rates are going up. Why would I want to be in real estate?
Well, but Fabio, talk about that, about perception, right?
Sure.
Because if you're in a major city, in New York, San Francisco, you see the vacancies. It's very upfront and out there here. But I'm wondering if the data itself backs up this idea of material softness in the commercial real estate space.
Well, it doesn't.
Yeah.
And it's very, very regional. And in fact, focusing on the Blackstone question, first, they're mostly in the South and West, which are areas that have seen growth. And actually, their total office space is less than 3% of the allocation. It's only got 3% of the allocation. Everybody knows, Scarlett's home away from home is the Bellagio, and is owned by is effectively owned by the trust. But all of their leisure stuff, which is exposure to COVID, and people know that. That's the only thing that they know that they own. Mm. But the reality is that too is less than 3%, and retail is less than 3%. This is a boring industrial, and they've got 28,000 rental units, and you couldn't name one of them, right? Because nobody cares. So I think that they also, to some degree, they suffer from just a desire to get out of real estate in general, and the misperception of it.
So misperception is where I want to go to, because when you restrict withdrawals, that sends a message. It doesn't matter what's inside the fund at that point. It's just like, wait a minute, we're not going to honor the fact that you want to take your money out. How do you navigate that? How do you nuance that when the headline is so obviously a knee-jerk reaction negative?
It's absolutely right. And that's like hedge funds had this period where they all imposed gates. And it was always said, sure, I have a gate clause. A gate clause is the same thing. We reserve the right to not give you your money back. Mm-hmm. And in this case, they gave it back to you pro rata, 5% a quarter, 2% a month. And what ended up, what everyone thought was anyone who gated, you would never do it because it would be the end of your career. And then what happened is so many people did it that they ended up it ended up being normal, and it hasn't harmed people who gated. So there's a chance that this could become the new normal. And the alternative is, REITs are a very tradable item, and you can go to a discount to net asset value, I suppose, right? In the Blackstone kind of vehicle, you really can't do that without selling at fire sale prices. And if everybody knows you have to sell, you're in a weird way doing a favor to the investor by keeping them from selling, at that point. But believe me, I've been in rooms where people have explained, I'm doing you a favor to an investor by not giving you your money back.
No one buys it.
What you hear is whoomph again. It's not a good place to be. It really isn't.
We're focusing in on Blackstone mainly because that was the headline of this week. But I'm curious as to whether some of its competitors, not necessarily just in real estate, but overall with that same business model, are they also facing the same issues, or is what we saw with Blackstone and the real estate redemptions, is that very much specific to just real estate itself, and particularly this pocket of real estate that those particular funds were invested in?
I think actually there are funds out there. There are real estate, and certainly, if you look at the REIT index, it's down some, 23% year to date, versus Blackstone, which is still up small policies. So it's a tremendous outperformance, and that comes from being in office space. Sorry, not being in office space, not being in retail, but being, in industrial. Right now, the cost to build a new building for industrial is about 114% of what it was a year ago. Right. There's about a 3-year demand for rental housing. There isn't enough housing stock out there. So what they own what you want to own. They're sort of the nicest house in a bad neighborhood. Yeah. But there's a lot more real estate, REITs and vehicles like that are in much, much, much worse shape. They're in much, much, much worse shape on a relative basis, and they're the guys that are going to see the outflows, and they're going to trade at discounts.
Before we let you go, I got to ask you about Bridgewater as well, because it did very well for most of this year. It was going to look like it was going to be the best annual performance in about a decade, and then it erased most of the losses. How do you read this? How concerned would you be if you were an investor in Bridgewater's funds?
October the 13th. October the 13th was this massive reversal date. Since I think 83, there's been only 9 instances of the stock market going down more than 2 and then closing up more than 2. On that day, it went down 4 and closed up 5. And since then, it's been going back up. Greg Jensen really has taken the reins. He's 48 years old. Yes, Bob Prince is out there at 63. But Greg, to his credit, was one of the first guys to step up to the plate and say, you know what, this inflation is not transitory. He was saying that a year ago.
He did.
And you print this amount of money, you're going to have consequences, real consequences. And as you know, if something is supply related, you increase supply and the price goes back down. But if it's demand related, the way you cure that is interest rates. That's a whole different vehicle, a whole different vector to slow it down. Prince was out there sort of saying this, but Greg Jensen just took it and ran with it and was totally public about it. And I think what this test is going to be for him is going to be anchoring. Because once you've said the world is going to heck, it's really hard to turn around and say, okay, I was wrong, or the worst is behind me. He positioned his portfolio perfectly for what was coming up. The question is, was October the 13th actually a bottom? And if it was, can he sit there and say, I've got to turn it around. And once you've publicly said something, it's a heck of a lot harder to turn around. And you see this on the show all the time. People hanging on to like the shreds of a call that they made that they should just say, I got it wrong. And he's going to find himself in that question. This is a real test, I think, for Greg. And I think he'll pass it because he's a tremendously smart man. But it's a test.